a bit more credit than that, and saying that I think he wants to take some air out of the tire.
Yeah.
Surely he's aware of watching what's going on in Australia on the yield curve. That's the area that's been causing the biggest problems. I think people worry that if they go too early in this yield curve, they're not going to be able to do it properly.
Well, that's, again, it's because they're they're always reactive, which shows you how little they understand. And they all sound the same. That should scare the hell out of all of us. It's like somebody puts out a fact sheet every day, and that's what they all read off of.
So as Judd pointed out, the financials got hit today on a yield curve going up.
Yeah, I know. Yeah, I've been watching that all day. Which, okay, they've had an amazing run. So
a good run, yeah.
Yeah, they're entitled to take a breath.
They are. It's maybe a bit of margin selling or something. I don't know.
Yeah, they're entitled to take a good breath, and okay, got it. Oil had a nice day.
Huge day.
Yeah.
And then all the oil names gave it up when we went risk off.
Yeah. So I guess, and that was because of Saudi Russia statements. So for all those who say, well, fuck the U.S., the U.S. needs to forget about it, you can do what you want. So, yeah, you're going to sanction the Saudis. Good luck to you, my friend.
Yeah.
There's more at work here. You know what? It's the problem in international relations as it is in economics. Some of these models are just so static. Their expiration date ended long ago, and they will never give them up. The world is just so far more dynamic and so much more diverse than any of these modelers want to give credit to. So why we wind up with a lot of policy mistakes.
So are you just gluing yourself to the 30 years and the yield curves around the world to see what's going on?
Until you know what? There was that piece I was talking about it in the FT.
Yeah.
Today, did you happen to see it?
No, I didn't.
I'll send it to you right now. This is an important read, I think, Andrew. These are, hold on, I'm sending it to you right now. These are your guys. Shoot, Andrew Perry at Gmail. No.
Thanks.
Hold on, I just sent it to you. You should have it.
Yeah, got it.
Okay, so let's open it together. Oh, there it is. You got it now. Okay.
Here's the yield curve. Stan just sent it to me.
Yeah, he did. Thanks, Stan. So the title of the article, Andrew, is Hedge Funds Cash In on the Great Reflation Trade.
Yeah.
So it talks about Caxton, O'Day Asset Management, QMA, Wani, all chalking up Jersey returns because it's been short the bond market.
Yeah.
Right?
Yeah.
This guy, Andrew Bear from DBMF, I don't know who that is. They made 4.5% last month with bets against the 30-year. So, and as soon as they don't see any response, then you saw it today. You have to be blind not to see this, right? Because as soon as he really didn't acknowledge the any hint of twist or yield curve control, the market fell apart. The 10 years were actually higher, the futures. The S&Ps were higher until he started talking. And, 5 minutes into it, when they didn't get what they wanted, boom. So does he really not understand what he says? Or is he on the payroll of these guys who are short? Hey, it's a big corrupt world out there. I asked that question, and I'm old enough to deserve to be cynical. Okay. And if
no, you certainly are. Sorry. Well, I would argue now, and I think we're playing that S&P Dow Jones to bond spread. I would argue, I think he was talking, the market was 38.40, was that right? On the highs?
Yeah, probably.
I would argue until we get above 38.40, you don't want to be long this market.
No, I know, but okay. So I'm going to put up a 5-minute chart because I think you're exactly right.
And I'll tell you what I was saying before, Ara, I mean, I'm not trying to be an alarmist. Last Friday, I was pretty forthright with my views on what the technicals were saying. And that's alarming in of itself in a normal market. Granted, with QE, it's sometimes unreliable because they just step in and fuck you. Excuse the French. But the amount of technicals across different asset classes was the reason I was getting alarmed. It wasn't just happening across one. It was happening across the Aussie. It was happening across the bond spreads. It was happening across the outrights. And I think by him playing with fire in this market, you've got to be a little concerned for sort of a mini crash.
Well,
because if the long end gets a run on, then the equities are just not going to hold up. Full stop.
I'm on a 5-minute chart. The high was made on the 11:05 Chicago time bar, exactly the time he started talking.
And that was 38.40?
It was 38.42.
Yeah, I think that's the number.
And the spoos, is that what you're talking about?
Yeah.
Put up a 5-minute bar. You'll see.
It's right here. And so you can see it at 10:30 and then, yeah.
Yeah.
Now,
here, I'll put
now
up
they're going to,
just to confirm.
and I think I know how your mind works because ultimately they're going to have to do something. So what's the next policy response?
Yeah, 11:05, 38.42 and a quarter.
I think that's the number. I think that's the number now. If while we're below that, you don't want to be long.
Everything, he put everything into motion. Everything.
Well, I think the Australians did 2 weeks ago when they couldn't hold the curve at 10 basis points, and it's snowballed from there.
I don't disagree with you, but the dollar made it slow basically right at that time. So it's all, that's the algorithms at work.
I mean, look at the Aussie dollar weekly chart. I mean, who wants to be along that outside rate reversal week? For God's sake.
You're seeing the algorithm at work, and it worked.
And here's a trade tonight, right? The open of the market, the close of last week was 77.07, and the open of the market was 77.69. If this market gets hit tonight, you sell that thing with a stop loss through 77.69.
Well, I mean, you just see it, and they're either oblivious. You see, I thought maybe, and I was giving him credit that maybe he's that much Machiavellian, okay? That he likes this because it's kind of doing their work for him, and yet he doesn't have to do anything on the short end, so they're having it all ways. And somebody said, they can't be that diabolical.
No, I think he might be right, but he's one of these days these buggers are going to be too cute by half.
Is what?
In the market. Yeah. One of these days these buggers are going to be too cute by half. They're going to basically try to think they're in control, and the market. It's always been the long end that's worried everyone.
Right.
And if that just slips on him when he hasn't, and I think you have to watch the next 24 hours. He had a chance to calm this down today. He didn't.
Well, all you got to do is the weekly SPOO bonds. That closes lower on the week. You can kiss the whole thing goodbye.
Yeah.
What? I'm sorry, John.
The SPOO bonds close lower on the week. It's AMF to the market. And every time these technical models have gone neutral, turned from a big uptrend and they've taken a pause and gone neutral, we've had anywhere from 500 to 1,000 point breaks in the S&Ps.
Yep. And when I laid out that possibility of a Machiavellian sense, I was having a discussion with somebody and they said, well, yeah. Oh, man, that might have been Angelo talking about Main Street, that is going to be better for Main Street than for Wall Street. But of course, that hasn't been true because we've seen what the large financial institutions have done, rallied like they were given infusions of Regeneron cocktails. They've been taken off. So it certainly hasn't hurt Wall Street. So I don't know. There are a lot of things in play here. It just makes me wonder what he knows. And does he really understand the impact? And listen, I don't care because I'm trading it. I don't care. But I'm just looking at it.
Yeah, but not many people do that. People are sitting here buying the dip because they've been trained like seals to do it.
Yeah.
And one day, if you don't know how to make it, you're not going to be able to keep it.
Well,
And
it's every couple of years. I mean, Angelo has got he bottom fished when we went down to the matrix level and a bunch of stuff. And, that's the way to manage your risk. It takes.
oh no, I agree. I mean, my only concern for not getting so aggressively short this market, it wasn't middle of the year, but look at I keep looking at that bloody gap in the Bitcoin chart down at 25,000. And knowing that's the 618 off the low, it's too cute that it doesn't go down there as well. And Ira, don't forget 1665 on gold, which is the 9th of April low from Jay Powell's
Right.
jump bond.
Yeah, so we were looking at off the long-term point and figure, Ira.
I know that's such a big area, and that's fine.
Here, right there. So it makes sense. Most of the kids in the room had, anywhere from 1648 to 1650, but this is, it looks like it has a target on it.
God help us if you close below it. That means the long end's going to get smashed.
Oh,
yeah. Yeah. So tomorrow, you really have to watch the 30 on the number because you still got this 157 and change. I'm still looking at the March. I think you're making a mistake if you extrapolate to the Junes. I think it's a week and a half, maybe 2 weeks too soon.
Yeah. Okay.
Oh, in the S&Ps?
No, in the bonds.
Oh. It is really fascinating to me to watch. That's all I'm going to say. Because we have never, and I'm going to repeat, never had the long end be the tail that wags the asset classes. It's always come from a rise in short-term yields. And right now, short-term overnight yields all the way out to 5-7 years are very negative. And I repeat, very negative in real yield terms. This tail has never wagged the entire asset models like it is doing now. And that's again, because the Fed promises to be pinned at 0. So this is all we have.
Yep. Well said.
And there's all kinds of shit going on, by the way, in the 10-year market because of the repo market and all kinds of fails. Because now there's a shortage of borrowable 10 years for repo. So there's some serious issues.
Yeah, they're just taking stuff off.
Oh yeah, I mean you saw it in you saw big liquidation today in a lot of things, and people should be. You know what? You better start getting a little concerned. I know there's the article that says never to sell. You don't sell anything. Okay, I don't sell. As I think with Rothschild, let me check that. I think Rothschild said when somebody asked him how's he so rich, he said because he took profits too early.
Yeah.
I think that was Rothschild. Let's see.
It was somebody else. I can't remember. Not him.
Okay.
It was it wasn't JP Morgan, it was somebody else.
Yeah.
Let's see. But it is a famous quote.
I mean, at some point this year, I have no doubt we're going to get potentially the trade of a lifetime. And that'll be hopefully getting gold around 1665 when he does do yield curve control.
We might get that tonight.
We might get that tonight. Absolutely. You got to be ready for the next policy response.
Yeah. So you put your wish order. You might get it tonight, because they always make a run somewhere.
I Googled it and it says Bernard Baruch.
Yeah.
Oh,
there you go.
oh, okay. You know what? That's even better. That's right. Bernard Baruch said it. I knew that it's a famous quote. Yeah. How come you're so rich? I took profits to earn. And you know what? There's a lot to be said. These last couple of days, this has been one of those days I have a lot of money made and then whoop.
Oh, Monday was, I mean, I sent that thing out on the weekend to you guys, and like Monday, I was like, oh my God, how stupid do I look? But you got to believe the numbers, and they didn't take out the highs. All they did was a 6 and 8 retracement. I mean, that NASDAQ chart looks horrible.
Yeah, well,
again,
the rest of the game right now is going to be the S&P low today, period.
I'm going to raise this issue again. The key to this, I don't even think it's Powell anymore. I think it's Yellen.
Yeah. What can she do? And what can she do to stop this?
Well, but if don't forget when they did this, and there is a history to this in 46 to 51, it was the Treasury who battered the Fed into doing it.
In 1971.
And I'll tell you, from my perspective, if I was a moderate Democrat, if I'm Manchin or if I'm Sienna from Arizona, where I'm at, who are more moderate and have openly questioned the need for a bigger stimulus, I'm sitting here and I'm going, well, I'm listening to Powell, and if the long end of the curve is saying what the Fed wants it is purportedly thinking it's saying, well then don't I start curtailing the stimulus package? It's a rhetorical question, but I think that it has.
No, I get, yeah. But I'm just, I mean, your comments on Powell not having a clue, I take, but the other way of looking at it, he's decided that he wants to let some air out of the tire, or he's decided that he's a bit worried with what the Australians are trying to do and they're not getting there with it, that he wants ammunition for the next time the market sells off so he can get a decent response. I mean, God forbid if he did, well, God forbid if he said yield curve control and the market did what they've done to the Australians, then we're in real trouble.
Well, you're going to have to run that risk one day, aren't you, Andrew?
That's the problem they've got. It's a house of cards. One day it's not going to work. Now it's very, very hard to invest in. That's why you really got to have your trading hat on. You cannot. It's a bloody. We're playing with fire. And that NASDAQ to bond, when that made 83.10, which is the objective, that led everything.
Well,
and the S&P bond, Judd, I think it did the 618 objectives.
Yeah.
And here's a pretty good rule of thumb. You get proactive and it costs you a lot less than when you are reactive.
Absolutely. Look, I recognized on Friday that I was going to have to give up upside, but I was not going to live with myself on the back of the technical damage that was done.
Yeah.
And because I'd rather trade my process, even if I'm wrong. That's just the way it is. Because I know that I won't deal with a 20, 10, 15, 20, 30% drawdown. That's just not how I trade.
Yep. Well, it's the world we live in, but they really don't understand. Better to be proactive than to be reactive.
Yep. Watch the currencies tonight. If the Aussie gives it up again, long end, then just. Whew.
Yeah, it's going to be busy. And tomorrow, you got to keep your eyes just riveted to what the 30 does.
Yeah.
Well,
look at dollar Sing, 133.75. That's not good, guys. Outside range higher last week.
In which?
Dollar Sing.
How much more do you think the dollar has to go?
Oh, well, if this is the start, a fucking shitload.
Well, Andrew, this is the last thing and that's a very good question. But
yes, it is. Sorry, I wasn't finding it specific. Yeah.
Unlike last year, when they put the swap lines together to push the dollar lower, if if that's, because I don't think, again, hypothesizing, I'm not forecasting. I don't think they want a higher dollar because of the huge amount of debt that's out there, which will really start, they can't get any traction to a sustained liftoff. Yeah, they get a good quarter here, but then nothing sustains itself. So higher dollar would really harm, especially if it came with a sell-off in commodity prices around the globe, would harm a lot of the emerging markets that they just had a giant G20 meeting about to see how they were going to help them. It won't help them. So you can't want that. So making yet another case for the proactive nature of yield curve control. Because if you did that, the dollar will sell off accordingly. I promise.
Absolutely. And that's where we're going to ultimately get to, I suspect.
Yeah. So,
I guess my response to that question, it was a great question in the sense that I'm just looking at purely a technical pattern on the Aussie and the dollar sitting. Both, one a reasonable Asian proxy for China, and the other one just a good commodity currency, and they're both bad patterns in terms of the currency, in terms of the dollar strengthening. The dollar strengthening is it's just not what the world needs.
nope, it does not. It will slow the global recovery enormously.
And the fact that we've come from, I don't know, Aussie went to 56 cents last year, I think 58 cents maybe.
Aussie was down.
So it can go a long way. But I think just on the day, the level that we spoke about at 40 in the S&P, that's 60 basis, that's 60 points. If you can get above there, well done. If you can't, then the downside's just too big for me to be long.
Yeah, well, it's simple. We close under today's lows. Goodbye. It's got a lot lower to go.
Yeah, and I think if you want to be short, if you want to be short, just run your numbers against 12,800 on the Nasdaq. It's been a great level.
Yeah. Yep.
The matrix number, I think.
All right.
All right, mate. Thanks for that.
Ira, thanks.
Yeah. Sorry, I couldn't be more, but this is the kind of world we're living in. So.
Absolutely.
No, you've been great. Just don't let the dogs, do anything to you tonight.
The dogs. You can have my dog.
It's why I get up. I'm a caretaker for a senior citizen dog.
Yeah, he's worried about the dogs pissing on his head in bed.
Yes, exactly right. All right. See you.
See you, mate. Bye. So, Joe, just finally on the Nasdaq, we pretty much want to leave the stop at say 12,950 would be fair now.
Yeah, if you want to risk that much.
I mean, I'm doing that because the three high weekly closes 12,883, 12,870, 12,905. The opening range this week was 12,957. Last week's close 12,905, and your matrix at 12,800.
Right. I mean, I don't think that it should really give you a close back above 12,800.
And the power high was 12,797. There you go. Goes above there, then all that stuff we just spoke about is nonsense.
Yeah, and we close under today's low in the S&Ps. People are going to be jumping out the window. So especially late day tomorrow. I mean, I wouldn't rule out another trip down there to check it out, because typically when we go to these matrix levels, like in the S&Ps like we did today, you get a pretty good rally, and then it might even rally one more time, but it usually shows it to you again to confirm it.
Yeah.
And
okay.
we haven't got the second trip to it yet. So I'd still be pretty cautious about what I'm doing here.
Yeah. All right. I don't try to sound like the alarmist, but it is what it is.
All right.
Thanks, mate.
Hey, thank you.